Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly review for the week ending February 17, 2023. So let's start with a look at this week's markets at the close on Thursday. So negative for bonds this week, and look, year to date, we are losing lots of the gains that were made. The major reason behind that move is that we are seeing the economy that's being much more resilient than we thought. So we used to put odds of 70 to 80% on a recession call in 2023, and now we are revising that lower, somewhere around 30 to 50%. So maybe just below the odds of what we would consider the base case now, because of the strength in the labor market that is apparent, because of the strength in consumer spending. Inflation is also a bit stickier as a result, because the economy is holding strong. So that means that the odds of rate hikes in 2023, new rate hikes from the Bank of Canada, because remember they're in a pause. We discussed that last week. Getting out of the pause and coming back with new rate hikes later this year. Maybe not at the next meeting, but maybe the next meeting they could announce that the meeting after is live, and the evolution of the labor market and wage growth and the stickiness of inflation is making them consider doing more rate hikes over the coming months, something like that. But in Canada, maybe getting out of the pause, and in the US, the Fed now, they're talking about maybe 50 basis point hikes at the next meeting, and continuing beyond May, which is what is priced now as the last date for 2023, where the market was expecting a hike, so maybe we could continue forward. So odds of a recession much lower than before. Now odds of rate hikes need to be brought up quite a bit based on the recent data, and this is what we're starting to see in the price movement of bonds. Equity is still positive for the week. As I'm recording this, it's Friday morning prior to market open. Futures are pointing in the red, so let's see where we end up. But on the right, you see we still have a very healthy return since the beginning of the year. We still think the absolute low of this bear market is not in yet, so we think that we should lose some of the gains here. And didn't bring the chart, but for technology stocks, so the Nasdaq retail was all over that since the beginning of the year when we look at flows, and it even pushed hedge funds of this world to cover their shorts very quickly. So one of the biggest short squeeze in the last decades that we just seen. So adding some fragility to the gains that we've seen on the Nasdaq here. So if you are long Nasdaq and you had some good gains, nobody ever gets poor by taking some profits. All right, so price of oil lower, US dollar stronger on the week, with the odds of further rate hikes being priced in. So that means that the CAD was weaker, Euro was weaker versus the USD as a result, and the price of gold down on the week. So focusing now maybe more on the Bank of Canada, so wage growth. This is reason to expect more rate hikes by the end of the year. And what we've been discussing quite a bit over the last year is that if inflation remains strong, then at some point it feeds into wages, which creates more inflation, which feeds into wages again, and you get into an inflation spiral. And we're starting to see some of that right now. So minimum wages were raised in 6 provinces in Canada since last October. Of course, no problem with raising the minimum wage, but there is this rule of thumb. Not every province follows that, but it's a general rule of thumb that the minimum wage is about 50% of the average wage. And since wages grew by about 7% or 5 to 7% in the last year, well, we're seeing large, strong raises in the minimum wage, which feeds into prices for services firms. So if they want to stay in business, they want to stay alive, they need to pass that on to consumers, which is fueling inflation, of course, in inflation perspectives for services firms. And that should create more inflation, which should feed into wages and all of that. And the cure for that, well, it's very simple. It's to put the brakes on the economy. This is what central banks are looking to do, and it's pretty clear that they need to do more quickly, because we're seeing inflation start to accelerate again when we look at the short-term pace. More on that in a few minutes. But when you go to the next slide here, The average hourly wage in Canada is yes, maybe it's topped, but it's still between 4 and 5%, which is a range that Mr. McLean specifically says the bank would be uncomfortable with. 4 to 5%, for inflation to be around target, you need to see wage growth at between 2 and 3%, between 4 and 5%. That's not enough, and wages can be sticky. Wage growth can be sticky, so it might take a while for wage growth to slow down enough, so that should fuel inflation for some time still. So the message here, again, sad message, but the economy is doing better than expected, so that's good, but that does lead to higher odds of rate hikes by the end of the year. In the US, inflation short-term trends remain too hot for comfort. So when you look on the left-hand side here, you see that year-over-year inflation, the lighter shade of blue part is what's behind the slowdown. That's transportation, so that's gasoline prices, new cars, used cars, but the other components are still pretty sticky. And on the right, you see month over month, a re-acceleration to 0.5% over the last month, so that's an annualized pace of 6% plus. And as you can see, lots of breadth, pretty much all of the components here join to the upside. So if you're the Fed and you look at that, you have to be concerned and you have to think that the job is not done. And maybe to complement that, the retail sales came out this week in the US. The consumer seems to be still alive and well because it's just one data point, but it was a strong growth from consumption. So if we're creating lots of jobs like we've seen over the last few weeks, that leads to a very good tailwind for the, let's say, a wealth effect for the consumer, and the consumer is more resilient than we thought. So that means that if the economy is more resilient, the Fed might have to do more to achieve its target of bringing inflation under control. So next week, when we look at the calendar, we see that we'll have retail sales in Canada, we'll have CPI inflation, so we'll have this side of the story for us up north. In the US, S&P Global Manufacturing PMI should be a bit higher, but still in contraction territory, below 50. The minutes from the latest Fed decision, we'll have a glimpse at the conversations that took place there. We're hearing echoes of Fed speakers that say that, well, they debated going 50 basis points in January. So let's see, in February 1st, rather. So let's see how heated that debate was. And some are even thinking of going 50 basis points at the next decision. So we're still in the midst of that. Core PC inflation, finally, that's another inflation index, but this is the one that is favored by the Fed in their analysis, and month over month 0.4%. Again, that's too hot for comfort, so we'll see that this is what we get. So that wraps it up for the week. ia.ca/economies, your go-to webpage. You can subscribe to the newsletter if you haven't done so already. In Your Interest podcast, new episodes every single week, and you can follow me on social media, Twitter and LinkedIn. So always a pleasure to serve you, and I'll be back again next week.